One. A very good day to you all. Welcome to the Wall Street Blockchain Alliance's Call the Lawyers podcast, episode number 9. It's been a little bit of housekeeping before we start. Please note this podcast is presented for general information and educational purposes only. Nothing discussed in this podcast should be considered legal, tax, investment, and or accounting advice. The views expressed here are our own, and they do not represent the views of either the WSBA or guest firms. So I'm Ron Quaranta, chairman of the Wall Street Blockchain Alliance, and my guest today is an old friend and colleague, Dan McAvoy of Polsinelli. Dan, how are you, buddy?
I'm doing all right. How about yourself?
Doing well. You've been a WSBA member for a long time, and I remember a lot of our conversations in the early days. Polsinelli, your firm, hosted a lot of our gatherings. We're going back to in-person in 2022. For the audience, why don't you level set a little bit for us? What do you do with Polsinelli? How did you get involved in the crypto space, and what's that journey been like for you?
Yeah, well, so I'm a shareholder in Polsinelli's New York office and co-chair of the fintech practice, primarily in the area of securities, investment fund securities regulation. And so I've been involved in the blockchain area for about probably half a decade now, originally starting with various use cases for stock exchanges and things along those lines, actually, as opposed to tokens and whatnot. But and then of course the whole ICO boom and telling people, hey, I don't necessarily agree with some of these other folks. a lot of those conversations, yep. For quite a while, but have been working pretty extensively with token issuers, investors, DAO structuring, and a lot of other work in sort of the various regulatory aspects that people have to deal with, custody issues for investment advisors, broker dealers, all of that other kind of fun stuff.
There are a lot of use cases there that you're working on. You're talking to token issuers, DAOs. I want to dive into those a bit later on, and I'm going to bounce around on our prep list, so don't hope you don't mind. We've got a very extensive legal working group at the WSBA. You and the team, Polsinelli, are kind of core members of that. And one of the things that we talk about frequently, particularly the past few months, I want to bring out is the kind of regulatory and legislative perspectives, right? The conversation about Washington. We're not a lobbying organization, but we certainly spend time with regulators. We've spoken with legislators. We work with our members and colleagues in the legal working group. And correct me if I'm wrong, Dan, it's like there's this real, I don't want to call it a negative shift, but a deeper shift towards skepticism about crypto assets, about blockchain. And what I would argue, Chairman Gensler, chairman of the SEC, some of his comments really blew my hair back when I read them, particularly lately. One of his comments, and I forgot what form it was, where he basically, and again, I'm paraphrasing, told lawyers, don't help crypto companies basically evade the law or cover up, or some bad verbiage I'm using. Let's explore that a little bit. As an attorney, you and your colleagues had to see that. And what were your perspectives on that? And why is that kind of that shift happening?
Well, I mean, I think some of it is just a shift with Gensler generally, and kind of being consistent with, who he's always been, and how things were when he was the head of the CFTC and things along those lines. But it's also kind of a shift back towards, the previous Democratic administration with Mary Jo White and the way that things operated then too. We're seeing a lot more of the telling people what they think via speeches and in statements and things along those lines. We know that there are a number of enforcement actions that likely are on the way for surrounding this, and in the meantime, I think that the SEC just proposed its first actual substantive regulation in about 10 months. The other day, there hasn't been a whole lot of that. I think it is as attorneys, our job is to try and help clients stay within the law, and to remediate, and in addition, look, sometimes people do things that get them into trouble, and that's the lawyer's job, So there's a difference between, I think what he said was poorly worded. And there's a difference between lawyers who are bad actors, and lawyers who are trying to help their clients work within an uncertain framework that you don't necessarily know where the lines are. We know certainly there are certain areas that fairly well known. Okay, you can't do certain things. You can't go ahead and just do an unregistered ICO of a utility token and sell it to everyone in the world and get away with that. That we know that the SEC is going to take the approach that this is an unregistered offering. But there's a lot of stuff between that and a full-blown registered IPO on an S1, and a ton, like it's an entire gray universe. And so we have to, help clients navigate that, and and hopefully what he really meant was, if you're somebody who's assisting with, clearly fraudulent activities or illegal activities, then you shouldn't be doing that. That's consistent with Sarbanes-Oxley. That's consistent with what it's always been to be a securities practitioner. But if it is a little bit alarming if what he meant was, we don't want you assisting people in trying to do something the right way when it's not clear what the right way is.
Yeah, it's interesting because so many, and a lot of what you're talking about mirrors the kind of policy positions of the WSBA, and we've had these conversations in our meetings and our working groups, where we want compliance with regulations that are what I'll call sensible regulations. And I think a lot of the members that we have and a lot of the colleagues we speak to in industry that come from that technology side of it. And I think one of the things they're afraid of is part of that lawyer's job is to help them see where the line is. And there's not particularly anything wrong with getting close to that line, insofar as it helps innovate or offer a service or capability. But one of the other fears that these innovators have is some, and I'll use some of the other comments from some of the other commissioners, right? Which is, it is not enforcement, is not regulation by enforcement, and some snarky comments from some commissioners that we can get into. I guess the question becomes, why shouldn't innovators in this space be afraid of regulation by enforcement, given the lack of standing regulation as it is? And how do you have those conversations with those innovators?
Well, there's definitely a level of risk tolerance that people either do or don't have. I mean, once again, this gulf is extremely wide. You look at the 3 no action letters that have been issued by the SEC, where they've said, okay, well, this isn't a security. Well, the one thing that really, at the end of the day, all 3 of them have in common is that you're issuing an unlimited amount at a fixed price. Well, there is, however, an entire universe of stuff that people are doing, and it's not, the question is just who is it who's going to innovate, and where are they going to innovate? And so, I mean, you can't just have a situation where the entire rest of the world is gaining on the US from an innovation and technological perspective, because the what one is able to do and what something that is considered to be sort of within regulations versus not within regulations are so different in one place than another that it just becomes not feasible to actually do that. And where you see really a lot of these issues are people who they have these great ideas and great projects and want to go ahead and produce these financial innovations and other innovations, and and people are going ahead and moving forward with projects in other places that are somewhat similar. And unfortunately, a lot of these people have to make the decision of, okay, well, am I willing to go ahead and take a little bit of risk, or am I willing to get left behind and just abandon what it is that I'm doing, or move to another country? So and some people, there definitely there are certain conversations that I've had with multiple clients where one client says, hey, I'm not going to do this at all. The next client says, you know what, I'm going to do something, but really small scale and try and keep as far as conservative as I possibly can be in doing it. And other people who say, well, that's the cost of doing business.
You think, and this might be more a more provocative question than either of us is comfortable answering, but do you think it's time, this idea of what is a security, which really industry is struggling to wrap their heads around. And for years, I'm not an attorney, Dan, as you know, but I've had more conversations with attorneys than I ever thought I'd have in my life. But how we
too
test,
many, I'm sure.
but the idea of what defines a security based on precedent and case law. Think how we test, for example. And when you look at the pace of innovation, we could talk about what we have on our list, right? Decentralized finance, interest-bearing accounts. Do you think it's time for a reinvention or a reimagining of what we mean by security?
Yes and no. So look, I think that the SEC has had some fairly aggressive interpretations, I guess I would say, that depending on where things go, may or may not wind up holding up. One thing that I do find interesting, and this is not something that really has been proposed for the US, although the other day Ripple came out with a short paper, basically saying maybe we should try and take this approach. And this is an approach that much of the EU has taken, Mexico has taken, Brazil, and a lot of countries throughout the world have this idea of a regulatory sandbox, where there are you're still subject to certain sets of regulations. There is oversight within that. You still need to get licensure, but the digital assets and the other sort of innovations that you're doing have a little bit more leeway. There's a little bit more freedom to what it is that you can go ahead and do within those circumstances. And so, look, if you're something like an exchange, the chances are you're subject to a set of regulations already. But if you are if you're going ahead and developing a second layer protocol to try and make Ethereum run faster and more efficiently, for example, as many of the big projects out there are doing, in many of these countries, you have the ability to go ahead and issue and sell tokens to be able to develop the project while still being, subject to the regulation of whoever it is who kind of fits best within what it is that they're trying to do. And frankly, the SEC is not the agency that fits best within what most of these people are trying to do. There are a lot of people where the CFTC is a lot closer to what they're looking to do, or the Fed or someone else. But I don't think the point of most of these projects is not to sell and issue securities. It's that there is a digital asset that may or may not fall within the definition of security, and therefore people are trying to comply.
That brings us pretty neatly to, you referenced several things there, the kind of regulatory sandbox, which makes me think about Commissioner Peirce's. I think we're on version 2 now of her proposed safe harbor. And having reviewed some of that, is it your thought that that is something that can become a reality in the current state of the administration and the SEC, or is that something that's just not going to get traction, do you think?
No.
To
put a little bit more on it, first thing, it is a little bit different than what generally has been proposed otherwise. I think it's been a great conversation starter, and I think that what Commissioner Peirce has been doing has been good for spurring a conversation within the industry. There are various parts of what the SEC is supposed to do, and yes, one of them is investor protection, and I think Gensler falls very, very heavy into the investor protection. But there also is having efficient markets and fostering innovation, and so I think that those areas Peirce is a lot more focused on. But this, as it's designed now, I think it's too different than what is presently out there. I also think that just giving people a free pass for a period of time probably isn't, if there were to be regulation, I don't think that's necessarily what would happen, particularly with the current administration. And I've even had clients approach me and say, hey, well, let's go ahead and try and do this and see what it looks like in action. And have to say, maybe you should think twice about that, because if you're saying that now you're saying it's a security potentially, and by the way, part of the protocol, part of that proposal is to give everyone's information and all of that. So maybe that's not what you should be doing, but
right. It also, you're kind of alluding to the regulatory arbitrage we've often spoken about in the industry. And there was a very large firm in the ecosystem, the crypto asset ecosystem, that proposed a new regulator, which a lot of the industry very broadly said, no, it absolutely won't be workable. But when I read their proposal, I understood the thought patterns behind it. What do you think about that? Like, because we just referenced, SEC may not be the best fit for every innovation in this space. We'll peel that back a little bit later. Maybe CFTC is not, perhaps OCC is not when we think about interest-bearing instruments. Do you think we need a new regulator, or do you think the existing regulators need to evolve?
I think that if it's feasible, a new self-regulatory organization, I think would be helpful. So not a new SEC, but a new FINRA, or a new NFA, as opposed to a new CFTC. I mean, I think that, having something there, where people are able to go ahead and set those rules and have those rules approved by a regulator, but ultimately, sort of monitored and enforced within the industry, and allow the the SEC to stick to its primary mission, and I think that would be helpful. Whether or not you can come up with the framework for that, whether or not you can get enough consensus, which is sort of funny to say, because in an industry that is like literally based on consensus, nobody has any consensus, and I think that if you tried to put these decisions on chain, I'm not sure it gets very far.
That's a really interesting point, Dan. I want to pivot a little bit. You do a lot of work with clients in different aspects of the blockchain and crypto asset world, and you and I have been in the industry long enough to remember when MakerDAO was kind of a new phrase for a lot of people, and the thing that popular media caught on was the original DAO hack back in the day. My argument and my perspective is that the world of DAO, of decentralized autonomous organizations, has evolved significantly. So give us a little bit of your perspective on kind of how DAOs are proliferating, what I'll broadly call the governance and structuring issues of DAOs. And again, I don't mean to pull this back just to a regulatory or legislative conversation, but that's a pretty rapid pace of innovation when we're talking about DAOs broadly. What are you seeing in that space? What are your clients seeing, and what are your thoughts about the future there?
Well, I think that the term DAO is likely to undergo a little bit of refinement. I suppose with DAOs, we're kind of at the same place that tokens were 3 or 4 years ago, where people just called everything a token, and really we're actually talking about 15 different things. So I think that the core underlying philosophy, I think, or what where you can sort of start to call something a DAO is having on-chain governance via smart contract. Now there are, and I work with a number of DAOs of various varieties, from pure DAO, no organization anywhere, to there is a DAO along with an associated foundation and an associated for-profit entity and all of these other things. And I think that part of the potential for confusion, and where I think there may be a little bit of movement is trying to determine, okay, well, what are the roles of these various entities within a project and non-entities within a project, and how do they fit together, and making sure that they're not deemed integrated, where they say, okay, well, yes, you have a foundation, you have these 3 corporations, you have this token, and the token is for governance, but really it's all part of the same thing, and therefore we're going to kind of combine everything together, and what's good over here makes it bad over there, that type of situation. So I think that that's one of the challenges that we're starting to see for that. But look, I mean, there's number one, if you are a not an organization at all, chances are you're a general partnership. A general partnership for legal purposes anyway. And a general partnership means that every person who's involved, every general partner has 100% liability for everything that the organization does. That's not ideal. In addition, if you don't have an organization, it's a bit difficult to do things like open bank accounts and conduct business, sign contracts, have attorney-client privilege. That's another area where it can be quite interesting, and in particular where everything is on chain. Maybe there's someone who you're engaged with where you have privilege, but in order to get something approved, you have to put it before everyone and have people vote on it. So,
right.
So that's one of the interesting pieces. But and then the third one is that, believe it or not, people actually want to pay taxes. They want to pay the minimum amount of taxes that they can, but want to actually comply with law. There are DAOs that there are just a couple of filings, and maybe we talk about this a little bit later, but who have tried to register their tokens with the SEC. So there's various things like that you just can't necessarily do, or at least don't fit within the current constructs if you don't have some type of organization that is a legal person. But at the same time, having an organization that is a legal person is somewhat antithetical to the spirit of a decentralized autonomous organization.
It's interesting you referenced paying taxes, and as you know, we have a very large accounting working group, and kind of the going theme there is now that the entirety of the government seems to see everyone in the crypto space as a tax scofflaw at some point. And no matter how many conversations you have about, no, we want to pay taxes, we just want to pay the minimal amount or reasonable amount with clear regulations around what gets taxed. But back on the DAO thing, I think it's really interesting because we have a lot of conversations with legal colleagues. I want to talk a little bit about governance models, and you deal with this probably a lot more than I would argue most attorneys, just broadly. Those DAOs all have different governance models. Is it a challenge from the legal professional's perspective to understand what those governance models are? You've been in the space for a while, so you've probably seen it all, but there are new lawyers coming into this space all the time. There are new law students that we have, some of them as interns within the WSBA. How hard is it to understand those governance models and explain it to people and your clients?
Well, I definitely haven't seen it all. And frankly, I keep seeing new governance models because right now there's a lot of trial and error. Once you're sort of in a certain place, unless you're either able to get a majority or fork or something else like that, you're kind of stuck with what your original design was, and that's part of the very nature of blockchain. So it can be difficult to figure these things out, and I think that from an outside perspective, it may be difficult for regulators to perhaps see, okay, well, who is it that is ultimately calling the shots if something happens? Who is liable if something bad happens? Things along those lines. And then in addition, I think there's also to some extent, and at this point, if you're participating in a DAO, you're already part of the initiated, but that's not always going to be the case, I don't think. I think that, as time goes on, as there's more widespread adoption, as these projects get larger and things along those lines, you will run into circumstances where people have essentially governance rights and voting rights, and they may not know what they are. And so I think that that's something that over time will develop better. But if you're not reading through every single section of the white paper, you may not know exactly what your rights are.
Yeah, so many colleagues that we know are sick and tired of reading white papers at this point as well. The evolution of innovation it brings us to another topic that we referenced, NFTs, non-fungible tokens, which went from JPEG art sold by people for ridiculous amounts of money and friends and family asking guys like you and I why we're not digital artists, to really a representation of true value for either digital or real assets that leverage blockchain capabilities and smart contracts. Which brings us right back to our original conversation around what's that line? Is it a security? Is it an offering? Is it a GP that is selling to LPs, depending on how it's fractionalized? You've been focusing on that a little bit as well. Give us the breakdown of what you're seeing in the NFT space and where you think it might go.
Yeah, well, look, I'm fully of the belief that, it may not be called an NFT, but at some point, everything, once you're able to go ahead and make the sort of connection between the real world and the blockchain and blockchain in a, trusted manner,
Yep.
that everyone understands and everyone trusts, that it's that leap that has to be made. But at that point, it just makes too much sense for there not to be things like, title that are put through what is in essence a certificate of authenticity. And so at least that's how I view NFTs, is that an NFT at the end, in my view, is basically a certificate of authenticity. Now, it's easy to connect that certificate of authenticity with something that's already digital. And therefore, the use cases that we've seen for NFTs up to this point primarily have been in that digital space, digital artwork, generative art, which I think is a burgeoning area that we're going to be seeing a lot more of. And I think that the next great generation of artists, may be very well, computer programmers more than artists in some ways. And so, but those types of things we're seeing, with NFTs and being a repository of value. But there's a lot of stuff you can do with it. There's no sort of one formula to creating an NFT. And so I think, there definitely are use cases that people have done or that do maybe veer into that securities area. I mean, even Hester Peirce said, like, hey, if you're fractionalizing an NFT and selling off fractional interests of the NFT, that's probably a securities offering. And it probably is.
It brings me to a conversation I had with a colleague in this space, and I think you and I are going to end up having this conversation eventually, which was, what are the securities laws going to look like in the metaverse when you're selling NFTs in a metaverse and you're fractionalizing them? And I know I'm digressing a little bit, but these are complicated topics about how different capabilities evolve.
Yeah.
What are you seeing in the next stages for NFTs from the perspective of industry, as well as do regulators get it?
As with anything, we will start to see more regulatory input when there's a big problem. I mean, I think there have been a few things where that's not necessarily the case. Like, I mean, stable coins have gotten a lot of attention, and I think that's an instance of, the government being more proactive. There hasn't been, some huge, I mean, there've been a couple of little blips, but nothing massive. But usually, most regulation is in response to something that, has happened that's bad. And so, that very well may happen in the future where people go ahead and pay more attention to it. But, there are NFT projects out there that do things like essentially convert into other tokens that might be securities, well as that a convertible security, or that have the capability to do certain things, or that give you licensing rights, or various other things along those lines where there's additional stuff baked into it. And so I think what's going to be kind of key is figuring out sort of the separation. Okay, well, where is it? Where is, you could have a certain digital asset that has characteristics both being an NFT and not being an NFT, and making sure that the NFT side doesn't kind of get swallowed up by all of the other creative stuff that people are starting to do more and more frequently.
As you say that, Dan, it makes me think, and some of these conversations have happened previously, is there also a copyright law or a trademark law conversation here? And I don't know if you focus on that much, but would love some of your thoughts there.
Yeah, I mean, look, there's no, and once again, it really depends how you've gone ahead and set up the contract and how you've coded stuff. You know, there is no, you do not, if you own an NFT of something, you do not necessarily own the underlying asset. You might just own the NFT. You know, depending, the default, unless you go ahead and, you know, write it in and sell it, but the default would be, you know, normally if you have an artist, well, that artist continues to have moral rights in the artwork and they can continue to commercialize stuff potentially. And you know, I guess the advantage of it being an NFT versus a poster on the wall, though, is that with an NFT, you can point to that specific one and say, we know that's the original one, and that the 1,000 that were made after it are not the original one. Those ones are the copies. Whereas if, you know, I go, you know, who knows how many of these there are, right? And the artist could go ahead and sell it as a one of a kind, and then, you know, make 5 more of them, and nobody would know which one's the first one. So,
right. You referenced stable coins earlier, and it brings me to one of the points we talked about in the prep emails. And again, this evolution of innovation because of underlying fundamental blockchain technology. So we're seeing stable coins. We've seen action, and again, regulatory action at the state level on things like interest-bearing crypto accounts and different types of lending. Tell us a little bit about that. To the extent you can talk about clients that are involved, or where you're seeing the landscape for that, and where that might be going, because in a lot of the conversations we have, that's here to stay, to replicate financial markets capabilities and maybe offer them to communities that may never have been able to have that before is pretty innovative. What are your thoughts there, and where might that be going?
I mean, look, I think they're going to be subject to regulation. There are a number of states that have brought actions already. I think there's heavy speculation that the SEC is, you know, following, and they did very loudly convince, you know, Coinbase not to launch its interest-bearing product. So, you know, it is something that certainly is going to be regulated. I think it's an easy one. Like it makes sense that because if what you're saying is, okay, well, basically this is a money market account, well, if then you know, it's pretty hard to argue that it's not a security if it's basically a money market account. But you know, that said, you know, there are ways to go ahead and, you know, sell these products. It may not be as retail as one necessarily wants it to be. And, you know, there are other licenses that, you know, may be required at a state level, depending on what it is that you're doing. You may need non-bank lending licenses or money transmitter licenses or whatever else like that. But, you know, look, that is going to continue. And I think where the more interesting and more difficult case is going to be, you know, really sort of the more traditional DeFi swaps and staking. Because, you know, at what point does staking start to look like lending? There's a pretty thin line potentially in the eyes of some.
You know, it's interesting as you raise that. And I want to go back to the Coinbase Lend product a moment, because it was interesting. Coinbase is a fairly significant organization with lots of lawyers, and they'd been working with regulators for some time. So it was pretty astounding to see the SEC push that they kind of pull the launch of that product. And a lot of people have predicted, well, because they're going to be cracking down on these products. But I think you're right, and I want to explore that other point a little bit on true DeFi. When we look at these platforms that offer interest-bearing capabilities in crypto, they're not truly decentralized, all things considered, right? There's for the most part, there's a company, there's a corporation, and all of that interesting stuff. But the challenges around true DeFi, this kind of true peer-to-peer finance, or what a lot of my technologist friends will tell me is peer-to-contract finance, which, because there may not even be a person or entity at the other side. You're just interacting with a decentralized financial smart contract.
Yep.
What are the challenges there, to the extent you can speak to that, and you've been looking at that with clients? And again, I don't mean to keep going back to the regulatory perspective, but that's hard for regular people in this space to understand DeFi, let alone how law applies to it. What are your thoughts on DeFi?
I have a lot of thoughts on DeFi. Yeah, we don't need to go into the hour and a half mark on the podcast, but you know, I think it is difficult for people to understand. I think that it's difficult for me to understand sometimes a lot of what's going on. There is, you know, there's very little question that certain DeFi activities, or might constitute. I guess maybe not that there's little question, but certainly the CFTC has fired off a couple of warning shots that you know, some of these products may be commodity derivatives, and that, you know, these exchanges should be, you know, actually regulated as commodities exchanges for that reason. You know, where it becomes really difficult, I think, is with the truly decentralized, you know, versions. And yes, most of them have some type of an entity, you know, alongside it or behind it. But you know, there's, and I think that this may be coming full circle to, you know, Gensler's statement. I think this may be part of what he was thinking of, which is, okay, well, you're helping people, you know, evade the law by just making it difficult to find them. Like, for example, that might be, you know, something that, you know, well, who's going after sushi? You know, who do you go after if you say SushiSwap is violating the law? I mean, it's a protocol. There are people behind it. You know, I'm not, you know, I don't know a ton about their, you know, formal structure or anything like that, but at least they, you know, claim to be pretty much fully decentralized, and it was basically a fork off of, you know, Uniswap. So I mean, yeah, if they're doing stuff wrong, who do you tell to register? Who do you go after? How do you shut it down? I mean, I don't think people know the answers to that, and at this point, and you know, it'll be interesting to see what they, you know, if there is a sort of a big event that happens, if we have a, you know, sort of GameStop that happens in that industry, who do the regulators focus on?
Right. And you know, it's interesting. You said something that really stuck in my mind. You know, there's this idea that there are these nefarious participants and actors around the world that are creating things and selling things, and of course there are. You know, the biggest ecosystem for money laundering and the illicit finance in the world is, you know, the global banking system. So we could have very philosophic libertarian conversations there, but we agree that there needs to be protection against that. But I think the other side of that, from a technologist's perspective, might be they may not even know what they're doing is wrong. And I know that sounds a bit simplistic, but when you look at the global reach and some of the things these technologists are doing, that's a legitimate, almost education question, right?
Mm-hmm.
And I wonder, you know, it makes me wonder where that goes over time. Who do they go to? A lot of these technologists, particularly the ones that are overseas, may not know to go to a lawyer and speak to about this. And I think that's one of the things organizations like mine and the work you and I are doing focus on trying to educate very, very broadly. I want to look at one other point, bit of a digression as well. But you and I've been in financial services for a very long time. You've had financial services clients, and you know the space very, very well. And when I see wash trade, we know what we're saying there. You referenced something that was really interesting, is kind of the closing of the proposed closing of the crypto wash trade kind of loophole. For the audience who may not understand that, can you tell us a little bit about that, and kind of how does the closing of that loophole happen? What does that mean for the industry?
Well, you know, it's one of a number of tax reforms that, you know, will be coming into play. You know, there are a number of things that are in the infrastructure bill that passed as well that are going to sort of change tax reporting and stuff like that. But you know, basically, if a wash trade is kind of, you know, locking in your losses for tax purposes and then buying back at the same price. If you do that with a security, if I go ahead and I own stock, you know, I own I don't know, Tesla stock, and it lost money somehow. I guess Tesla's a bad choice. You know, and then I sold it and then bought it back at exactly the same price. without the wash trading rules, I could argue, hey, I've taken a big tax loss that I can use to offset my gains, my capital gains for this year's taxes. And what the wash sale, rules say is if you buy it back within a certain amount of period of time, if your transactions are too close together, you can't do that. You still treat it as if you owned it at the original basis. You can't take your loss for this. You can't just lock in your losses for this quarter. Now, up to this point, the IRS view has been that that crypto is treated as property. And the infrastructure bill changes that a little bit. It seems like, anyway, it's not 100% clear, but it seems like they've said, okay, well, actually, we're treating these as securities, in which case, you close. People have been doing that with their, incredibly volatile assets. And so if I'm a crypto trader and I bought, Bitcoin at 60 and then it drops down to 40, I can go ahead and sell and take that 20 as a loss potentially to offset my other gains that I've had on other digital assets that I've sold. And so what I found really funny about this, though, in particular, was that as this was getting announced, there was somebody who sold himself a Bored Ape for like $500 million. And if you go ahead, you look at the chain of transactions, it's like basically he's like, all right, I'm going to pump up my basis in my Bored Ape. So that way it's like, worth $500 million. And that way when these wash, I at least I think that's the hypothetical behind it, is that, okay, well, I'm going to instead lock in gain, like sort of, so that way over time, if I sell it after long enough, I'll be able to go ahead and take a tax loss. I doubt that's going to work. But it was kind of funny to see somebody like literally, just shatter the record for the sale of an NFT, and then you follow like all of the trail, and it was just them selling it to themselves.
I kind of feel like tax attorneys are going to be really busy over the next couple of years or so. You referenced the infrastructure bill. I think we've got a moment or two to talk about it. And I don't know how deeply you want to go on this. One of the provisions in the infrastructure bill that just cleared the House, and we're all tracking that very closely, kind of really impacts the definition of what a broker is and how that impacts the crypto. Do you want to speak to that a little bit? And is that kind of crossing the radar of your clients?
It is, but it's also something that's far enough away from actually being effective that you can't be too worried about it. I have had a couple of clients express concern that, well, maybe we need to exit the U.S. market because this isn't something we can that we're going to be able to comply with, because while we do comply with KYC laws and things along those lines, the information that you would be required to give goes beyond what the information that you're collecting. And in some jurisdictions, there's even a bit of a conflict between the two. So for example, when GDPR first came into play, there were quite a few areas where GDPR said you couldn't provide certain personal information, and the law in the US said, well, you have to. And so there are those types of conflicts. The good news, I think, there, and while the definition, two pieces of good news. One, yes, the broker definition is potentially very broad, but that's going to be subject to regulation. And there, we'll have to see how broad that really winds up being. It's impossible to predict what's going to happen there. It's impossible to predict when this goes into effect in 2024, what the industry is even going to look like, because it developed that fast. So, but there are, the other piece of good news is that there are a lot of, projects that are thinking about this, have already been thinking about this, and are making big strides in getting digital assets that help verify identity, help perform KYC, help you keep your own information. I think this is one of the potentially long-term freeing factors of blockchain, with the opposite end being sort of the some of the CBDCs and things like that that may be tracking all of that information instead. But there should be an ability within these projects, to hopefully create a digital asset that can, sort of work alongside of you to provide the information that's needed for these legal reporting purposes, and to not become as big of a burden as I think some people fear it might be.
Right. And I feel like we can have this conversation for hours. I want to share, as we start to wrap up, one of my favorite readings, I wanted to give you an opportunity to talk a little bit about it, is the Polsinelli bit blog that you published too, and Stephen and some of the others. If folks that are watching this want to follow you, find out more about what's happening, or register for BitBlog, which is literally one of my favorite blogs, particularly from a legal perspective, how can people find out more?
Go to polsinelli.com, or and we can from there should be links to go to my bio. There's a link there, and go ahead and pull up the bit blog. We always trying to come out with interesting content, and a lot of times we'll not only try and keep people up to date on things, but also provide some analysis. I have my thoughts, for example, we didn't get to on the SEC rejecting the registration for the Wyoming DAO, forthcoming along with some more snark about one of those snarky speeches you were talking about. So
we may have to do an episode 2 of this, my friend. But Daniel McAvoy, shareholder at Polsinelli. Dan, always a pleasure. If I don't speak to you, happy holidays to you and the family. I'm going to leave it there. Thank you all for watching. Anyone interested in information about the Wall Street Blockchain Alliance, please check us out, info@wsba.co or www.wsba.co. Thank you very much.
Thank you.